Want to know the brutal truth about investing $1,000? Your parents' strategy won't work anymore. That CD account your mom keeps talking about? It's basically worthless now. Look, I lost $3,000 when I first started investing because I followed outdated advice. But today I'm going to show you exactly how to grow $1,000 in 2024. And yes, it's completely different from what worked even 5 years ago. Back in our parents' day, investing was simple. You'd walk into a bank, open a savings account, or buy some government bonds, and boom, you'd earn a decent 5 to 6% interest rate. People could actually retire on that. Wild, right? But here's what changed everything. After 2008, interest rates hit rock bottom. That same savings account? It's now giving you like 0.1%. That's literally $1 on your $1,000 per year. You can't even buy a coffee with that. So what actually works in 2024? I'm going to break down 3 modern strategies that are perfect for beginners. And no, I'm not going to tell you to buy some random crypto or chase meme stocks. Strategy number 1, index ETFs, the new savings account. Remember how our parents would save money in a bank? Today's version is buying index ETFs. These are like buying tiny pieces of hundreds of companies at once. Think of it like ordering a sample platter instead of betting everything on one dish. The most popular one is called VOO. It follows the S&P 500. Over the last decade, it's averaged about 10% returns per year. That's 10 times better than your savings account. With your $1,000, you could buy about 3 shares right now. But here's something most people don't tell you. You need to pick the right broker. Back in the day, you'd pay like $30 per trade. Now, companies like Fidelity and Charles Schwab let you buy ETFs for free. That's right, 0 commission. Your entire $1,000 goes straight to investing, not fees. Strategy number 2, fractional shares, the game changer. This didn't exist in our parents' time, and it's huge for beginners. Let's say you want to buy Amazon stock. One share costs over $3,000, way more than our budget. But with fractional shares, you can buy just $100 worth. It's like buying a slice of pizza instead of the whole pie. Apps like Robinhood and M1 Finance let you do this with any amount. You could split your $1,000 between different companies you believe in. Maybe $200 in Apple, $300 in Microsoft, $500 in an ETF. The control's in your hands. Strategy number 3, dividend growth investing, the long game. This is like combining the best of old school and new school investing. Companies like Johnson & Johnson and Coca-Cola pay you money just for owning their stock, and they increase these payments every year. Your parents might remember collecting dividend checks in the mail. Now it all happens automatically in your account. With $1,000, you could buy about 7 shares of Coca-Cola. They pay about $1.84 per share each year. That's around $13 annually just from one company. Here's the cool part. Reinvest those dividends to buy more shares. It's like a snowball effect. After 10 years, those 7 shares could turn into 12 or 13 just from reinvesting. But let me tell you what not to do with your $1,000. Don't buy penny stocks. They're basically gambling. Don't follow random stock tips from TikTok. Don't put everything into crypto hoping to get rich quick. Don't let your money sit in a regular savings account. Now here's something that would blow our parents' minds. You can literally start investing while waiting for your coffee. All these brokers have apps. 2 minutes and you're done. No paperwork, no visiting a bank, no calling a broker who charges you hundreds in fees. The most important thing, start now. That $1,000 isn't going to grow itself, and inflation is eating away at it every day it sits in your bank account. Our parents had the luxury of high interest rates. We don't. I actually made a calculator that shows exactly how much money you could make with each strategy. Want to see it? Check out my next video where I break down the numbers. Hit subscribe so you don't miss it. Because trust me, you don't want to keep losing money to inflation while everyone else's investments are growing.